Okay, chapter 14. Chapter 14, we're still going to deal with the corporations and retained earnings for the corporation and income statement. Just briefly to go back and say, corporations, what kind of corporations we have? The two type of corporations was public and private, correct? The public corporation is the one that the shares are traded on the market, actively traded on the market. What market? Secondary market for the shares. The private corporation, those shares are not traded on the market. So today we're going to stop and we're going to talk about of the retained earnings. Last week we talked about the contributed capital, from where the contributed capital comes. And when the people who contribute their capital, what they're expecting dividend. Today we're going to focus on the retained earnings. Again, on chapter 13, we cover the contributed capital, issuing the shares, cash dividend, and we take a look at the corporate balance sheet. Today we're going to see the retained earnings, how we're repurchasing the shares, what is stock dividend and stock split, and corporate income statement. Those are our objectives today. Let's go with first question today. Which of the following statement you think is correct? Let's go one by one. First option, common shareholder receive dividend each year. Is that true? No. Okay, great. Second one, retained earnings is a result of accumulation of the cash from sales shares. Is that true? No. Then the number of the shares issued is the number of the shares corporation is allowed to sell. That also doesn't look right. So the logical choice will be letter D. Now, what's retained earning and what retained earnings represents? Retained earning will be the accumulated lifetime net income, which is kept in the company. Retain mean to hold. Now, the retained earnings is part of the equity section. It's going to have a credit balance, normal credit balance. What's going to happen if for some reason the retained earning end up with debit balance? Well, that will be called deficit. From where the retained earning comes? The retained earnings, as you remember from the 1110 course, comes from the income summary account. At the end of the period, in chapter 4, we talk about when we're closing entries at the end of the period. The last closing entry is to close the income summary account. Where we're closing that income summary account? Into the retained earnings. Now, depends what's the balance on the income summary account. That will reflect the balance on the retained earnings account. If the balance on the income summary account is credit, that means the retained earnings, we're going to transfer into the retained earning credit balance. If the income summary account end up with debit balance, we're going to transfer to retained earnings debit. What means credit in the income summary account? That means that the revenue is more than the expenses. Since we already know that on the credit side is always sales and revenue, on the debit side is always expenses. As long as the revenue and the sales are higher than the expenses, the income summary account we're gonna end up with credit balance. Credit balance, obviously, we took that credit balance in the income summary. In order to close it to zero, we have to debit that account. If we debit income summary account, on the other side, we have to credit something. Which account we're gonna credit? Retained earnings. So now we're transferring the income from the period into the retained earnings. Retained earnings comes only and only from net income. Unless there's some exception, of course. There are always exception, but in general, retained earnings comes from the net income. Now, is the net retained earnings equal to cash? Absolutely not. Same thing, is the income is equal to cash? No, it's not. Now, the only thing is that make retained earnings a little bit more different than the income is the retained earnings is the entire income or loss from the operations from the start of the life of the company. How are we going to get the ending retained earning balance? Well, obviously, on we have beginning balance, and since it's the account that have normal credit balance, the beginning balance will be on the credit side. Ending balance also will be on credit side. Credit, that means everything on during the period accumulated in the credit is going to increase that balance. Everything on the debit side is going to decrease that balance. What we expect on the credit side, that will be the net income. And what we expect on the debit side, that will be the net loss or the dividend. Simply, we can do it this way. Statement of retained earnings, that will be the example. Beginning balance, always. We're going to add the net income for the year or the net loss on the year. Then we're going to deduct the dividend that was declared, and we're going to get the ending balance. Now, one thing that you should know that when the dividend become a liability, can somebody remind me about that? When it's declared. That's excellent. So, payment of the cash dividend, it doesn't trigger the liability, correct? The declaration of the dividend triggers the liability. In that case, dividend for the year is going to reduce the retained earnings when the dividend payable is declared. Make sense? Not the when the cash dividend is paid. So if the cash dividend is paid after the end of the fiscal year, with that, the dividend that we declare is still going to reduce the retained earnings in the current year. Retained earnings and the cash dividend, again, to declare the dividend, we have two conditions that has to be fulfilled. First, we have to have retained earnings before and after declaring the dividend. We cannot declare more dividend than the retained earnings that we have in our retained earnings account. Second condition is, if we want to pay cash dividend, we have to have a cash. It won't make sense for the company to borrow money in order to pay dividend. Usually, if the company don't have a cash or corporation don't have a cash, they're waiting until the cash is collected. Once the cash is collected, the dividend is declared and paid. Let's see how we're gonna deal with the stock dividend and stock split. We already know about the cash dividend. Cash dividend, what was the interesting about the cash dividend? We have three events there, correct? Three major dates. First date was the date of declaration. Second date was the date of record. And the third date is the date on which the dividend is actually paid. On which date we recording a journal entry? On the declaration day. Is there journal entry for the cash dividend? Yes. What's the journal entry? Debit something, credit something. Which account we gonna create? Debit retained earnings, credit dividend payable. Excellent. Date of record. What's the journal entry on data? There's no journal entry. No entry. The same thing that you have to do, I believe this, you have to put that no entry on the, when you're doing your assignment in Pearson, on the declaration date, you have to choose, drop down and choose no entry. Otherwise, it's not going to accept it as a correct answer. And the last thing left is the payment date, distribution date. What's the journal entry on the distribution date? Debit dividend, credit cash. Excellent. So now let's see, having in mind this, what's the difference between having a stock dividend versus cash dividend? And then we're going to see what the stock split is. Now, the stock dividend, a distribution of corporation's own share to the shareholders. That's the pure definition of the stock dividend. So instead of giving the shareholders cash, we're going to give them shares. Also is known as a share dividend. What's going to happen when we do that stock dividend? Stock dividend, we're going to increase the number of the common shares on the credit side, and we're going to decrease the retained earnings. So what's the difference? Let's do the Excel. Let's go back to the Excel spreadsheet. And let's start working on the Excel spreadsheet. Do you like those Excel spreadsheets when we're working on the Excel spreadsheets, by the way? Is it clear for you when we're using the Excel spreadsheet or more difficult? Which one is it? More clear. Okay, let's go now to the Excel spreadsheet then. This is our Excel spreadsheet. So let's do this. First, let's get the T account for retained earnings. Let's make it like a T account. With beginning balance and ending balance. Okay, we got the retained earnings. So now what we have to do is put here beginning balance. On which side will be the beginning balance? On this side obviously will be debit. On the other side will be credit. So where will be our debit and our credit? Means what will be the normal balance of this account? Now I cannot see your chat. Let me bring your chat on the screen so I can see it. Otherwise, I cannot respond to you. Credit. Okay, excellent. That's our credit. That's our debit. Now we have a perfect T account. So beginning balance obviously will be on credit side. On which side will be the ending balance then? On the credit side. On the side that the beginning balance is, on the same side is the ending balance. Now the easiest way to remember this is, I'm not sure if we talk about it, but let's go to the basic accounting equation, which was asset is equal to liability plus equity. That's our basic accounting equation, correct? So now the easiest way to remember which one is debit, which one is credit, well, just draw the T account right here. And the T account will be like this. So basically, if I want to go directly through the sign of equal, but I cannot go through that. But if you draw the T account, the line right in the middle, whatever left on the left side, we're gonna have always debit balance. Whatever left on the right side, always gonna have credit balance. So what's left on the left side? As you can see on the left side, left assets. So for that reason, assets, normal balance for the assets, always and always gonna be debit. On the right side, we have liability plus equity. So that means liability and equity always and always gonna, normal balance gonna be credit, unless there's some exceptions. There are always exceptions from the general rule, but definitely, basically that's a general rule. So now, that's our retained earning account. What's coming in? What did we say? Something has to come in. Otherwise, this account never gonna have balance. So what's gonna happen? In the beginning of the company, when the company starts, what's the beginning balance of the retained earnings? Zero. So what's gonna drive the retained earnings then? Sales, expenses, and then we're gonna have either we're not gonna either we're gonna have either we're not gonna have net income. That net income is gonna go to retained earnings. So that net income is gonna increase the retained earnings. What's gonna reduce the retained earnings? Obviously, the retained earnings is gonna be reduced by what's the first thing that reducing the retained earnings? Net loss. What represents the net loss in this case? So the net income here is increased on the retained earnings. Net loss will be when the sales expenses are more than sales, correct? And there's another thing that reducing the retained earnings, and that will be the thing that all the shareholders want, dividends. Excellent. So we know what drives the retained earnings and how this balance, let's say from zero, can increase or decrease. That's our general rule. Now let's see. First, we have to deal with cash dividend, correct? That was the first thing, cash dividend. For the cash dividend, let's move to the next one, and I'm gonna erase this. In order to declare dividend, what we said, we need to have net income or retained earnings, and we need to have a cash for the cash dividend. And first we have on the first date was declaration date, correct? On the declaration date, we have debit retained earnings, credit dividend payable. This is for cash dividend. Second, on the second date was date of record, and the date of the record we have nothing. Last date, distribution date. Or payment date, depends how you want it. And then we're gonna have debit dividend payable. And credit's gonna come from cash. When we're recording the liability on the declaration date. That's now clear for us on the declaration date. That's why we're recording the liability. That's why we're recording the payable. Once we record that payable, that become a contractual agreement. So basically, it's unavoidable. We cannot avoid the dividend at that point. Or we cannot say, go and say, you know what, we cancel. We change our mind. Let's cancel this dividend. So let's see what's going to happen now. This is the first, and the last thing is the cash, the date that we are actually paying the cash. So let's get this, copy it, and move it here. And let's see now what's going to happen if we have a stock dividend. On the declaration date. On the declaration date, again, we're going to take it from the retained earnings. There's no other options. All the dividends come from the retained earnings. But now we're not going to have a dividend payable because obviously you cannot pay people with the common shares. It's going to be different term now. And obviously, at the end on the distribution date, you're not going to give them cash. What you going to give them now? What do you think we're going to give them? Yes, we're going to give them shares. That's correct. So now the question is, if we don't have a dividend payable, what exactly we have? Which account we're going to create? Well, we're going to credit account, which will be common shares, dividend, for distribution or distributable. Common shares dividend distributable. So since we opened this account on the credit side, the same account we have to close on the distribution date on the debit side, correct? There's no other options here. We have to play with exactly the same account. So here the debit will be on the common shares dividend distributable. What if we declare dividend to the preferred shares? What will be the name of the account now? If we're giving the dividend, stock dividend to the common shares, it's going to be common shares dividend distributable. What if we give the stock dividend on the preferred shares? What will be the name of that account? Can you guess? Yes, that's exactly what it's going to be. What's going to change? Instead of C, we're going to have P. Shares are shares. Instead of common, we're going to have preferred. Everything is the same. So we said we not give them cash. What we're going to give them? For the common shares dividend distributable, we're going to give them common shares. For the preferred dividend distributable, we're going to give them preferred shares. And we're done. So the question here arises, what's the main difference? Well, the main difference is what the shareholders get. Imagine you're the shareholders. You're the shareholders. You're holding share of a company which is listed on the stock exchange. What do you want? What do you prefer? Obviously, you want dividend, no questions about it. You want dividend. But what kind of dividend you prefer to have? Now we can see that you can have two types of dividend. You can have cash dividend, you can have common shares dividend. Which one you prefer? Cash, of course. And no, and don't blame me for that. Everybody wants cash. Why? Because when you go to the market and you buy something, they're going to ask you for cash. Try to pay with the common shares, see what's going to happen. So let's go back to the slides. And let's move now to the slides and let's see what the slides tells us. As we already saw, the stock dividend we're going to increase the common shares and decrease the retained earnings. Effect all will be on the accounts within the shareholders' equity. So the total shareholders' equity is going to be stay the same. So now let's see here. Example. Our example is assume that the company declared 10% stock dividend on the 75,000 outstanding shares. Assuming that the market is 1.5 per share, now we have to calculate the stock dividend, which we're going to distribute. What we're going to use the current market value for the shares. We have 75,000 outstanding shares, which the market value $1.50. That's going to give us 75,000 times $1.50. That's going to give us 112,500 total value, market value of the shares. We're going to give them only 10% stock dividend. So amount that we're getting times 0.10. So the dividend that we're going to distribute as common shares will be for the 11,350. What's going to happen? The journal entry obviously will be debit retained earnings, credit common shares distributable, dividend distributable. On the day of the distribution date, now we're not talking here. Let's go back to the Excel spreadsheet and let's adjusting some to some extent the terminology just to make it fit our. Again, going to be distribution date. Actually, here we can call it. This one can be distribution, or here we can be payment date because we're going to pay that cash. Where here it's clearly distribution date. Why? Because we're not paying common shares, we're distributing common shares. So on that day, the common shares number is going to increase, retainer is going to decrease. The main difference, as you can see, is here we're reducing the retained earnings, and we're reducing the final effect is the reducing the cash. Well, in this case, we're reducing the retained earnings, but increasing common shares. That's why in this scenario, the total capital doesn't change. Total equity doesn't change. Where here, equity goes down, assets also goes down. Do you see the difference? It's important for me to understand that you see the difference. And the effect that you're going to have here on the balance sheet for the cash dividend, and the effect that you're going to have on the stock dividend on the balance sheet. The other thing that I want you to pay attention is on the declaration date here, we're creating the liability. When we're declaring stock dividend, is this a liability now? Do you see payable? No. What that means? No liability. And how we settle this distributable, dividend distributable with the common shares. We're not touching the assets here. We're increasing the amount of the common shares. Let's go back to the slides. So what's going to happen? As you can see, the total shareholder equity before was $250,000. After the stock dividend is still $150,000. What changed? Retained earning went down with 11,250, and the common shares increase with the same amount. Now, what's happened with the number of the shares? Well, they increase with 11,000. From 75, they went to 82,500. Why? Because we give them on 75,000 outstanding shares, we give them 10%, which is 7,500 shares. Why company will decide to give the shareholder stock dividend? One of the reasons might be to preserve the cash. I expect some major cash outflows. I want to keep my shareholders happy. So I'm going to give them dividend, but instead of giving the cash dividend, I'm going to give them stock dividend. The other option will be to reduce the market price per share. How that market price gonna reduce? By increasing the number of shares. Again, as you can see, the total equity here, it hasn't changed. What's changed? The number of the shares in change. So then we can expect that the market price per share, since we have more available shares outstanding, the market price of the share, it might go down. Not necessarily, that's just a guess. So let's remind again, as with the cash dividend, there's a three key dates on the stock dividend. First is the declaration date, where the board of directors announced that there will be stock dividend distributed to the shareholders. Then we have date of record, and then we have the distribution date. In this case, it's not payment date, it's purely distribution date. Valuation of the stock dividend is usually based on the market value. On which date? On the declaration date. So if the question give you a market value at the declaration date, payment date, and the date of record, use the market value at the declaration date. And based on that value, calculate the dollar amount for the dividend that has to be distributed. Don't forget, the dividend has to be distributed. It has to be stock dividend has to be in number of shares and dollar amount. The journal entry, we already talked about it. Retained earning, stock dividend distributable. Date of record, no journal entry. On the distribution date, stock dividend or common stock dividend distributable, common shares. Now, as we already noticed, since the common stock dividend distributable doesn't have at the end payable, it doesn't represent liability. So this is a not liability account. The other thing that I want you to remember, I think that will be the next one. Next slide. The other thing that doesn't make it liability is that the board of directors, after they declare stock dividend, they can cancel that stock dividend any time before the distribution date. When the company distributes stock dividend, the public can simply say that this company actually capitalizing the retained earnings. Why? Because they transfer the amount from the retained earnings into contributed capital. The question is, do I have to pay back the contributed capital? Does the company have obligation to pay the contributed capital to the shareholders? What do you think? Let's paraphrase this question. Imagine this. Today, you decide to invest in Apple. Let's say the Apple actually doing the public offering. So you're buying money directly from Apple, not on the secondary market, directly from the company. Let's say you pay $100 for that share. So now you have one share and you pay $100. Question is, the next day, can you go back to Apple and tell them, I want to sell my share, buy it, and I want my $100 back? Can you do that? No. Does the company have obligation to buy your shares back? No. So do you understand now when company declare stock dividend, they converting retained earnings into the common shares. Once it's converted to common shares, I have no obligation to pay that one money back. But if it stays in the retained earnings, you may ask me for cash dividend. Do you see the difference now? If I declare stock dividends, yes, you're getting shares, but I have no obligation to buy those shares back. So basically, I'm capitalizing the retained earnings. Keep it in the company. Where if I declare cash dividend, I have to give you cash. Now, stock dividend, it's a no legal liability even when it's declared. Why? Because board of director can cancel anytime that stock dividend between the declaration date and distribution date. They can even pass date of records and still can cancel that one. So remember it. Common stock dividend distributable is actually equity account. It's not a liability account. Let's see now stock split. What's a stock split? Trying to find some sheet of paper here around me. Let me see if I can find sheet of paper. And I'm going to show you the stock split. Let me see, how can you see it? Can you see this sheet of paper? Now let's pretend this is a one share. This is actual share for the company. It's a one share. Make sense? So I want to split it for every share to have two shares. There's nothing on the sheet, it's an empty sheet. The question is, can you see the sheet? Can you see it right now? Okay, no, let me try to remove the background and see if it works without the background. Just a sec. Just give me a sec. How about now? Can you see the sheet? So pretend that this is a share. So if I want to split this share by two, what are you gonna do? There you go. Now I have two shares. Imagine the whole share, the market price was $20. After the share split, what will be the expected market price of every share? What do you say? $10. If I decide to split now for every share to have four shares, what will be now the market price per share? $5. Make sense? What's going to happen with the number of shares outstanding? Instead of one outstanding shares, now we're going to have four. Depends on the stock split. Make sense? Okay, let's go back to Douglas. And let's go back to slides. Now you understand what the stock split means. Increase the number of authorized shares and the outstanding shares with the proportional reduction in the book value of the shares per share. Is that actually the proportional reduction of the book value of the shares? That's out of question. Is that gonna transpond to the proportional reduction of the market price per share? That's kind of unknown until you actually happen, and then you have to see how the market's gonna respond. But yes, the general purpose is to reduce the market price per share. Stock split will leave all the accounts balances and the total shareholders' equity unchanged. So the balance on the common shares is not going to change. Shareholders' equity is not going to change. What's going to change? Just number of shares. Since that's nothing is changed, there's no journal entry. So from all the events that you want to happen in reality, you want stock split because there's no journal entry. You just have to record a memo or additional information to the notes to financial statements. So let's see this. Assume that the market price of one common shares is $100 with 400,000 shares issued. The company wants to decrease the market prices to $50. What they have to do? Yes. So what they have to do is to split it by for every share to get two. What's going to happen? Most likely, market price is going to go down to 50. Again, it's questionable, but that's what we're chasing. Most likely, the market price is going to go down to 50. The number of outstanding shares definitely is going to increase. Why? So let's see the example here. Before the stock split 2-1, we have total shareholders equity of $5,800,000, common shares $4 million, retained earnings $1.8 million. After the stock split, we still have common shares total $4 million, but the number of the shares now is different. It doubles. Retained earnings is the same amount, total shareholders equity is the same amount. Now, what's the average book value of the share? That's a different story. Here, the average book value was $100. Now, the average book value is $50. Now, can we do the opposite of the stock split? Yes, we can. Can I show you that example with the sheet that I just did? No, I cannot. I cannot put back two pieces into one. I can make from one piece two pieces, but then I cannot put it back. But how we gonna call this one in reality? That will be a reverse split. Why do we want to do that reverse split? Because we want to decrease the number of the authorized and outstanding shares. And we expect the proportionate increase in the book value per share. Is that gonna transfer directly proportionate increase on the market price? We don't know, but the market price definitely per shares definitely is gonna increase. What's a similar between stock dividend and stock split? Similar is that both increase the number of the shares, which are owned by the shareholders. Neither of those changes the investor's total cost of the shares owned. Both increase number of the shares issued by the corporation, and both cause increase in the number of shares, which most likely is going to decrease the market value per share, not the book value per share. Book value per share obviously is going to change, but we're talking about the market value. Differences. Now, why the shareholders don't like stock dividend? Because the stock dividend is taxable. For that reason, the corporations usually they refrain themselves from issuing the stock dividend. That's going to make the shareholders very, very, very unhappy. Why again? Because they have to pay taxes. Imagine you getting shares and you have to pay taxes in cash. Did they get cash? No. Do you have to pay cash for the taxes? Yes. Where stock split, on the other hand, that doesn't create a taxable income for the investors. Shareholders' equity, implication there, stock dividend, shift the amount from the retained earning into contributed capital. Total book value is going to stay unchanged, but the book value per share will decrease. So where the stock split doesn't have effect on the account balances. However, the book value of each share will change. Depends, is it stock split or reverse stock split? Let's do one question now. Which of the following statement is not true? Is the first one correct? Let's go one after another. Is the first one correct? Yes. Second one, B. Is that B correct? Looks like correct. C. Yes. Then why D is not correct? It's a debit to retained earnings. That's correct. If it was debit, then it will be correct. Thank you. Let's go to the next question. What will be the journal entry to record declaration of stock dividend? Why is incorrect A? Because it's payable. There's nothing to pay. We're not paying, we're distributing. And it's not once it's payable. Remember, once you see payable, that means liability. In the stock dividend, there's no liability there. Let's go with another one. Which one is true here? Let's go with first one. Stock split increase market price of shares. Is that true? No. What's going to happen when we do stock split? What's going to happen with the market price? Most likely it's going to go or decrease. Stock dividend increases the number of shares issued, but split stock split does not. Is that true? False. In both cases, we're increasing the number of shares. Let's see D. Stock split creates a tax income for the investor receiving the shares. Is that true? No. It just doubled the shares that the investor holds, but doesn't create any other tax implications. Why? Because the stockholder, the taxpayer in this case, it doesn't get anything extra. He just replacing one share with two shares. There's nothing extra here. There's no benefits for the taxpayer in terms of getting something extra. All right, so now let's go and start repurchasing the shares. We saw last time what's happened when we issue shares. Once we issue shares, what we're doing? Or let me paraphrase the question. Once we issue shares, what we getting? What can we get when we issue shares? Only cash? Assets. I can get assets. Capital. So listen, Ruth. Capital is the one that we giving. We're gonna give. Or maybe no. Actually, incorrect. Yes, you're right. Capital, because we can. Actually, our asset is our capital. Yes, we getting capital. We're gonna give them common shares. Yes, it's correct. In general, in the big picture, capital is correct term. Okay, we're not gonna do attendance. Don't get scared. That was on the time when we actually were in the class. Since we are not in the class and we're recording this lecture, do you want me to take attendance though? Okay, so let's see why the company wants to repurchase their own shares. First reason maybe because the issue all its authorized shares and it needs to get some shares back in order to give them to as a bonus to their employees or anything like that. Second reason, maybe it helped to support the share's current market price. So if I see that this is also very interesting. If the company sense that the shares are undervalued on the market, the company can easily start buying its own shares back from the market. What's going to happen? Obviously, the number of the shares of that company on the market is going to go down. What we expect to happen there? The price is going to increase. Imagine this. Imagine we are on the grocery market. How can we increase the price of the tomato? That will be one way to reduce the supply. What will be the other option? How can we increase the demand? By reducing the supply, correct? If I if I reduce the supply, the demand is going to increase. So how can I reduce the supply? Purchase all the available tomato on the market. If I buy today all the available tomato on the market, plus the market on the warehouse on the suppliers, I'm going to create a demand for tomato. The price is going to go up, and then I'm going to start selling tomato, but I'm not going to flood the market. I'm going to just selling small batches. So now I can exploit that high price. The other one will be the other reason. So that will be one way to you to see it. I want to use that example so you can see how you can increase the demand. And when the demand is increased, then you can control the market and the market price. The other one is the other reason why I'm buying the shares back from my company is to avoid takeover. If I sense that somebody, so that will be another reason. If all the suppliers sense that there's a single customer that start buying all the tomato on the market like crazy, they don't want that, or maybe they want it. It depends. So what they're gonna start doing? They're gonna start buying tomato too, or taking the tomato back from the market. That's what the company start doing. If the company says that the single buyer start buying too many of the shares and his percentage start increasing, the corporation is going to start probably is going to start buying its own shares. So the person who's buying those shares, he cannot reach 50% and take a throw over the company. The other one will be to meet some share ownership requirements or limits. Now, Canadian Business Corporation Act requires that all the purchased shares has to be cancelled. Now, generally, a repurchase is only allowed if the corporation has sufficient cash, which makes sense. At the end of the day, you don't want to use your operating cash to buy your own shares. Now, the repurchased shares will decrease both assets and shareholders' equity. Why the assets? Well, because we have to use the cash. Those shareholders, they want cash. So in order to reduce my shares, so basically once I'm buying the shares, I'm reducing the shareholders' equity by using the assets, which is cash. Some provinces in Canada require purchase share to be cancelled. Means that destroyed. Once they destroyed, you cannot use them anymore. Where the other allow those to be held as a treasury shares. So every time when you see anyway in the question treasury share, what the treasury share represents, that's the common shares which are purchased back and not destroyed yet. So let's see this company has the following shareholders' equity at February 28th. They have a contributed capital, common shares of 100,000 shares authorized. This is how many they can issue and sell within the life of the company. Only 9,000 of those shares are issued and outstanding. Retained earnings, total shareholders' equity. So I'm going to grab this one and I'm going to flip it on the Excel spreadsheet. At this point, that's the only information that we have, so I don't need to flip right now on the Excel spreadsheet. I'm going to keep the Excel spreadsheet empty. And once we come to the point that we need the Excel spreadsheet, we can go back to the Excel spreadsheet and see what's going to happen and start using the question. Again, I'm going to copy this and let me flip it on the Excel spreadsheet and go over it. Okay, I already have it on the Excel spreadsheet. So what can we see from here? What's the average issue price per share? That's the only thing that we can see here. We have 9,000 common shares outstanding. The price that we collect for those shares is $180,000. So basically, our average issue price that we get per one share is $20 per share. Now, let's start working one after another. Now I can flip to the Excel spreadsheet. And we can work together on the Excel spreadsheet. So what we have at this point, let's see, what was the date? Let me see what was the initial date. February 28th. So let's say here on this happened on March 1st. On March 1st, that's what's happened. Company has a shareholders' equity, which shareholders constitute two sections: contributed capital, which is common shares, 100,000 authorized and 9,000 issued and outstanding, and retained earnings of 24. Now, what we established already, that we established that the average issue price per share, it will be equal to 180,000 divided by 9,000 shares. Or that's going to give you equal to 180,000 divided by 9,000. That's going to give you $20 per share. Now, let's assume that on March 1st, company repurchased 1,000 shares at $20 per share. What we buying? What we gonna buy? What we gonna get when we buy the shares? No, 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 no. Simple, simple thing. Listen this. Listen again. Listen the question. What we are buying? Common shares. So we're getting back the common shares. Make sense? We're not issuing the common shares. We're not selling common shares. We're buying common shares. So debit will be common shares. Common shares are outstanding. Now we getting them back. So we have our debit common shares. Make sense? Now, what's the value of those common shares that we buy? How many shares we buy? We buy 1,000 shares. And the average price on our books for those shares are $20. So we buy common shares for, based on our books, we purchasing back 1,000 shares at $20 per shares, so 20,000. Now, how much we paying, that's a different story. Now, how much we paying there? In this case, we paying, first we paying cash, correct? We paying cash. How much cash we paid? Let's be clear. How much cash we paid? We purchased 1,000 shares, and for those shares we paid $20 per share. So that will be exactly the same. 1,000 times $20. We pay $20,000. Our debit and creditor equal, right? We in balance. Do we have to do anything else? No, right? So what's happened now with our income statement, shareholders' equity? What do we have now? We have contributed capital, which is constitute common shares, which common shares right now we have how many outstanding we have now common shares? 8,000. And what's the total total amount of that common shares? Used to be 180. We purchased 20 for 20,000, 1,000 for 20,000. So what's the amount now for the common shares? That's sitting on the contributed capital. Any guess? 160,000. Okay. So we have our common shares. What else we have? Retained earnings. How much our retained earnings? Same amount. That there's no changes in the retained earnings, 24,000. How much is our total shareholders' equity now? Those two together. What's happened with the shareholders' equity? Going up or going down? Going down. With how much? With the $20,000. So the purchase of the common shares, so reducing the total shareholders' equity with $20,000. That's all happened. What else went down? Cash. Assets went down with 20,000. But we know, since we're not chasing asset, we try to see the implication on the shareholders' capital only. That's why we're gonna stop. Let's stop that share. Let's move to the slides and see now what's happened with the slides. So again, the average issue price per share is $20 per shares. When we repurchase 1,000 shares at $20, we're repurchasing the shares which average price is $20, and we're paying exactly the same amount. And what's happening now? Our equity is going to go down with $20,000. Now let's see another scenario. I'm going to flip now back to the Excel spreadsheet. I'm going to save you from seeing the other scenario. And I'm going to flip the other scenario directly on the Excel spreadsheet so we can comment on the Excel spreadsheet. And here we go. On April 30th, the company repurchased 1,000 shares at $15 per share. Now the question is, at this point, how much is our average issue price per share? Obviously, it's not 180,000. Now we have 160,000 divided by 8,000. So how much is our average price per share? 160 divided by 8,000, $20 per share. Make sense? So is the average price per share change? No. Okay, so now let's repurchase those 1,000 shares, but now let's repurchase for $15 per share. This is how much we pay. First, what are we purchasing back? Common shares, correct? We're repurchasing common shares. How many shares we repurchasing? 1,000. Now, 1,000. 1, 2, 3. And those shares sitting in our books at $20 per share. So what's the value of the common shares that we're repurchasing back? 1,000 times $20 per share. 20,000. Correct? Oops. Not that one. I don't need this one. I need only. What happened here? I hit the wrong button, didn't I? $20,000. Now the question is how much cash we pay for that. So the cash we're gonna get at 1,000 shares, and we pay for those 1,000 shares $15 per share. So that will be 1,000 times $15. We pay 15,000. At this point, my debit is not equal to credit, as we can clearly see. Now I'm not in balance. What do I need? Do I need more credit or more debit? Credit. So we have to create account. Now the question is which account I'm going to create. Let's think about first something. If I buy something for $10 and I sell it for $15, what do I have? I have revenue $15. How much is my profit in this case? $5. Now listen to me carefully now. Profit or gain, in order to have a gain or have a profit, I have to buy something and sell it. Make sense? So, in order to generate profit or to generate gain, I have to purchase something and then I have to sell it. Once I sell it, if I sell it above the price that I purchase it, that will be profit if it's normal course of operation. If it's not my normal course of operation, that will be gain, clearly. Now, in this case, what's the difference when it comes to this particular situation with the shares? Initially, did I bought the shares or sold the shares? Sold the shares. Now I'm buying the shares back, but on the less price. So imagine this. I sold my shares. So before we jump with this, listen to me carefully so you can understand it. To kind of feel it first. What's happening here? I'm having this book. I'm having the textbook. Which textbook I'm selling to you for $100. I'm buying from the publisher for 50. I'm selling to you for $100. Now, how much I bought from the publisher, it doesn't matter. It matters how much I'm selling it to you. I'm selling it to you for $100. Make sense? Now, at the end of the course, this book has no value for you anymore. So I'm coming to you and I'm asking you, if you give me the book back, I can give you $50. What's that for me? Is it gain? Is it loss? Is it profit? What is it? Let's go back to definition of gain. Gain is the difference between purchasing and selling. Is that what we have right now? Again, I'm I bought the book from the publisher. Let's say let's make it actually a real example. I'm buying the book from the publisher for $50. I'm selling it to you for 100. I'm making my gain $50. Correct? At the end of the semester, this book has no value for you anymore. I'm coming to you and telling you, I can give you $80 to buy the book that I sold you in the beginning of semester for 100, what's this for me? Is it gain? Is it loss? Is it profit? Or something else? It's something else. Let's agree that it's something else. It's not a gain. Because later on, once I buy it from you for $80, I can sell it again for $100. And I can still generate my $20 gain. And I keep going and keep going, keep going. The question is, if I sell you something and when I buy it back from you on the lower price, what is that for me? Because it doesn't meet any definition of profit, it doesn't meet any definition of gain. So if this happened with the common shares, let's think about what exactly happened. You have investor who investing $20 for one of your shares. Later on, you buying from the same investor the same share for $15. What's happened with the $5 difference? You keep it, correct? Now, that's not called gain. That's not called profit. That will be called contributed surplus. It's a surplus. And since from the capital that has been contributed to you, we're gonna call it contributed surplus. Make sense? So do you understand the whole idea here? Somebody pay you $20 for one share. Later on, you're buying the same share from the same person, but you're buying it cheaper. You're paying only $15. So now you keep the $5 for yourself, and now you can sell the shares again. So the $5 in this case will represent contributed surplus. And that's how we're gonna record it. But we're gonna keep track of the contributed surplus that we're creating. So that contributed surplus can come from the common shares or from the preferred shares, or depends on the class of the shares that you're purchasing back. So in this case, common shares or contributed surplus for common shares, or common shares contributed surplus. And how much will be that surplus? $5,000. Make sense? So let's do our shareholders' equity. What's happened now with the shareholders' equity? Common shares first. How much? 140,000. How many? What's the number of the common shares that left now? Outstanding, 7,000. But now we have a new thing, new element of the equity section, which is called common shares contributed surplus. And that contributed surplus is how much? 5,000. What's happened with the retained earnings? Any changes in the retained earnings? No changes in the retained earnings. How much is our total shareholders' equity now? 169,000. Make sense? What's the other effect? What's the effect on the other side of the equation? Our shareholders in equity reduced by how much? What's the reduction in our shareholders' equity now? From here all the way here. What's the difference now? 15,000. Can you see it? From 184, we went down to 169. This one minus that one. We earned 50,000. That's a reduction in the equity, correct? What else we reduce on the other side of the equation? Cash. How much? 15,000. Are we in balance? Yes. That was the whole objective. We to keep the accounting equation in balance. So let's check the slides and see how the slides see the whole situation. Again, the average price we already established is $20. This company repurchasing 1,000 shares for $15. So basically, we're purchasing the common shares, which initially was issued at $20, 1,000 of those. We're paying $15,000 cash, and now we have $5,000 difference, or $5 per share difference, which is converted to $5,000, which represent contributed surplus related to the common shares. If we have to do the shareholders' equity, we start with 184. Now the number of the value of the common shares goes down 140 with 20,000. Number of the shares going down 1,000, but we have a new element of the shareholders' equity, which is called contributed surplus. Common shares repurchase $5,000. Now we have to contributed capital 145. Retained earnings $24,000, and the total shareholders' equity is 169. Now let's go with another example now. Let's go back to the Excel spreadsheet and go see the next scenario. I'm going to give you a break after we finish with those one because I want we to stay in this type of questions so you can see the whole effect here. And then I'm going to give you a break so you can process the whole information. So the next scenario is this. I'm going to again copy it from the slides and going to come here. On May 10, we're going to repurchase 1,000 shares, but now we're going to pay $30 per shares, which let's see, and let's eliminate this one, and we're going to see what's happened now. What is our average price per share? It should be the same, correct? So now we are 140,000. 140,000, and our number of shares is 7,000. So this one will be equal to 140. 140 divided by 7,000. So our average issue price per share is still $20. There's no change in that price. But now we're purchasing, again, we're purchasing 1,000 shares, but now we're paying $30. Here, how much we paying? We're paying $15, which is below the average issue price. Now we're paying $30, which is above the average issue price. What's going to happen in this case? Let's go one after another. We're still going to buy those shares. There's no change here. We're buying 1,000 shares at $20,000 because those are 1,000 shares with the average issue price per share $20, 20,000. Now, what's going to happen with the cash? That cash is going to change now, right? Let's see what's going to happen with the cash. Cash, we're going to pay, instead of 15, we're going to pay $30. So how much cash we're going to pay? 30,000. Make sense? Now we are deficient, yes. We're paying more than what we get. I get $20 per share. Now I'm paying for the same shares. I'm paying $30 per share. I'm paying $10 more from the price that I get for those shares. So my problem now is on the debit side, correct? So now I have to start debiting accounts rather than creating accounts. In this case, since you're paying more, and again, we're saying that we are repurchasing, we're not selling, we're repurchasing, they cannot be loss here in this case. So what's going to be? And from where we're going to get the difference? The general rule is this. If that happens, if you start paying more than what you get for the common shares or for any shares, you're going to have, you're deficient, you're going to have deficit. Deficit, you're going to cover it from retained earnings unless you have a contributed surplus for the exact same type of shares. If you have a contributed surplus for the exact same type of shares, first you're gonna use the entire contributed surplus, and if you still haven't covered the difference, then you're gonna go to the retained earnings. Make sense? So we're gonna check the equity section and we're gonna see, is there contributed surplus related to the shares that we're purchasing back, which are common shares? And we're seeing, yes, there's a contributed surplus. How much is that contributed surplus? Is $5,000. Let's use it. And we're going debit, common shares contributed surplus. How much is that? $5,000. Is that solve my problem? No. How much I'm short? 5,000. From where I'm gonna get that time? $5,000. Retained earnings. Then debit, retained earnings. 5,000. Did I solve my problem? Yes. So now let's see what's happened with our equity section. Common shares. What will be the amount here for the common shares after this transaction? 120,000, correct? Why? Because now I still have only 6,000 outstanding shares. Contributed plus. What's happened with the contributed plus? 0. That will disappear. I don't have it anymore. How about the retained earnings? They're gonna go up or down. Think about it. We're debiting retained earnings. Down. It's gonna be 24 minus 5,000. Where's my shareholders' equity now? 139. So let's do our check. Let's see what's happened with the previous period. Shape. Let's get the shape and let's put it here and let's see what happened now. How much is my difference? 169 minus 139. $30,000. My equity goes down with $30,000. On the other side of the equation, do I have $30,000 reduction? Yes. My cash going down with $30,000. Am I in balance? Yes. All right, this is the challenge with so let's go back and see what's happened here. When we're issuing the shares, we're getting cash. We're assigning average price per share every time when we're issuing the shares. What will be the average price per share, issue price per share? The value of the shares divided by the number of outstanding shares. If we repurchase back the share at exactly the same average issued price, there will be no difference between the cash that we pay and the value of the common shares, in this case, that we're purchasing back. If, however, we repurchase the shares below the average issue price, that's going to generate contributed surplus. We're going to pay less cash, and that's going to generate contributed surplus. If, however, we're paying more than the average issue price, what do we have to do now? Since we're paying more than average, with the money, we're getting $20, but we're paying $30. I have to get it from somewhere. The general rule is if there's contributed surplus to the same type of shares, use that surplus first until the surplus disappear. Once the surplus disappear, go to retained earnings. So imagine in this case, there was no surplus here. No surplus. How much are we going to use from the retained earnings? Directly the entire amount. So don't jump directly to the retained earnings. When you're doing the questions, don't cover the deficit from the retained earnings right away. Check the question if they contribute surplus related to the common shares that you're purchasing above the average issue price. Use that contributed surplus first. After that, go to the retained earnings. Now, let's go back to the slides, and I'm going to let you for break so we can process it, and we're going to continue with the next issue. So, again, here, what happened is we purchasing now above the average issue price. The rule is get the common shares, retire the common shares first of the issue price. Second, pay the cash. See how much is the difference. If they contributed surplus, wash out the contributed surplus first. And if you still have a difference, start taking from the retained earnings. So when the shares are repurchased at the price above the average issue price, the existing contributed plus related to the previous repurchase of this class of shares must be reduced first. If it's not enough, then you're going to retain earnings. Once you do that, what's going to happen? That contributed surplus will disappear. Common share is going to go down with 20, and the retained earnings is going to go down with $5,000. So again, the general rule is, as a journal entry, if your purchase price is above the average issue price, sorry, if the purchase price is less than the average issue price, so if you purchase it cheaper than what you get, then you're creating contributed surplus. If you're purchasing for more than what you get and you have contributed surplus, wash out the contributed surplus and bring it to zero. And if you still have a difference, use the retained earnings. And if you purchase above the average price and there's no existing contributed surplus, take everything from the retained earnings. Process it. I'm going to let you for break for how long break you want. So that's how repurchasing the shares, and those are the issues when arising from the repurchasing the shares and how you're dealing with them. So what's we gonna do when we purchase those shares? Well, eventually, later on, you can sell it back, unless you have to destroy it, because as you remember, the shares that company repurchase are called treasury shares, and based on the Canadian Corporation, Canadian Business Corporation Act, in some provinces, you have to destroy them. Now, repurchase, sale of shares, that does not affect net income at all as you sell. Even if we're paying less than what we initially get, that creates contributed surplus. If we're paying more than what we initially get, that's reducing our retained earnings, but not net income. Fully disclosure is required, and insider trading is not allowed in this case. So let's do one question here and let's see how we're gonna deal with this question. Now, this company repurchased 1,000 of own shares for $15 per share. Later, the company sold 200 for $16 per share. How the entity is going to record the sale of the 200 share? What do you think will be the right? So let's read the question. Okay, let's read the question. Company repurchase 1,000 own shares for $15 per share. Later, the company sold 200 shares for $16 per share. The entity record the sales of the 100 share is. What we're doing here, are we buying back or we selling? Selling. Are we clear on this? We're selling shares. When the contributed plus is created, when we buying, when we repurchasing, or when we selling shares? When we rebuying. Are we rebuying? Again, watch this. We don't know how much is the price. We don't have that information. I cannot say, did they repurchase originally those 1,000 shares below or above the average issue price? The question is, when they sell those 200 shares for $16, what I'm gonna get? Stay with the question. We can talk about repurchasing the shares, but when you see question that ask you for selling the shares, stay with the question. So we're selling 200 shares and we're getting $16 per share. So how much cash we get in total? 3,200. What's the total amount of the common shares that we're gonna issue? Of the 200 shares that we're gonna issue? $3,200. What will be average issue price per share? $16. What we repurchase from before, it doesn't matter. That's in the past. The only thing matters is what we're doing and which entry we have to record. Okay, next question. On January 1st, company has authorized 100,000 common shares. On February 1st, 10,000 shares were issued at $20 per share. On August 1st, 500 was repurchased from the shareholders at price of 25,000 per share and canceled. What's the balance in common shares on August 1st? Let's think first. Once we issue the shares, what's the journal entry? Again, once we issue the shares, what will be the journal entry? Do you want me to move to Excel? Let's move to Excel then. Let me flip to new sheet because I need fresh sheet without anything. Let's delete those one first. And let me grab the question and bring it here. Can you guys see the question? Okay, so let's think about it. First, on February 1st, give me the journal entry quickly. Debit, what we're gonna get? I'm looking for quickness here. Cash. How much cash we gonna get? 10,000 times $20 per share. Make sense? And that will be credit common shares for the same amount. Correct? Now, what's my average price per share, this issue price per share? $20. No questions about it. Why? Because I have 10,000 shares times $20 per share. Average price is $20. Now, on August 1st, I'm going to repurchase back 500 of those shares at $25 per share. So how much you going to retire? Debit, common shares. I'm going to retire 500 of those shares. And what's my average issue price for those shares? $20. So what will be the value of my common shares? $10,000. Make sense? Now, how much I'm going to pay? Credit cash. How much cash I'm going to pay? 500 times $25. 12,500. Correct? And I have to debit retained earnings. With $2,500. Now I'm in balance, correct? So what the question asks? Read the question. Tell me what the question asks. What is the balance in the common shares? So which account I'm chasing? Common shares, correct? What do I have in common shares? Initially, I had the beginning balance, 0. Then I purchase common shares. Sorry, issued common shares. I didn't purchase. I issued common shares for 200,000. Then I retire common shares at 10,000. So what's my balance of the common shares account? Make sense? Stay with the question. Read the question, please. Pay attention what the question asks. Don't go crazy. Once you see those uh, calculation, those share price here, that purchase price there, contributed surplus comes, stay with the question. Don't get snowed by the question. or by the information before the question. Don't answer the questions that no one asked you to answer. Again, the question is, what's the balance in common shares? $190,000. What will be 187? 187,500. What will be answer for that? I have no idea actually what's, no, that will be 2,500, yeah. 127,500, that will be amount of the total equity. Amount of the total equity will be 187,500. But again, we don't have enough information because we don't know where the retained earnings is. So you can see how many different conclusions we can make here. But the answer is 190,000. So let's keep going with the slides. Make sense? Let's go to the next one. Let's go now to the next objective today, and that's to prepare detailed corporate income statement. For that income statement, what we have to do is the net income. Why do we need that net income for? Because it's going to show us, do we have ability to generate income through the operation? How successful is the operation? Are we building assets and shareholders equity? Can we get new investors? Now, income statement is going to look like this. Always going to start with sales. Sales, and after that, it's expenses, 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 expenses. To some instances, you might see gain or sale of the machinery or gain on disposal of some, but generally, it's only expenses, expenses, expenses. For that reason, sales is only on the top, always on the top. Then we have cost of goods sold. Then we have gross margin. Then we have operating expenses, which are listed individually. Then we're going to come to the point that we're showing the income tax expenses. Once we show income tax expenses, we're going to finish with the income from continuing operations. Those will be the operations that are going to repeat every period and every period and every period. Then we're going to have a discontinued operation. Discontinued operation will be, is there any segment of the business that we close and we're not going to continue anymore? And from the discontinued operation, as you can see, we have operating income and we have gain on disposal. The interesting part is this, and you remember it. Once we show income tax expense on the line of the income statement, that's the last time that we're showing income tax expense. What that means is you cannot have more than one income tax expense line on the income statement. Only once. And only from the continuing operations. Everything after that, it will be less or net of taxes. For every amount that you're showing after that point, the taxes has to be deducted. That's why you have here net amount, gross amount 60,000, net less income taxes, $39,000. Capital on disposal 10,000, but when we eliminate the taxes of 3,500, only 6,500 are included in the income statement, and then you have net income. After that, you have earnings per shares. Now, continuing operations, again, income from continuing operation helped the users of the financial statement to understand and predict the business and future earnings. Income tax expense, again, you have it as a one line and one line only. Everything after that is net of taxes. Earnings per shares. It's important for the investor they to understand how much is the earnings per shares. For the earnings per shares, formula is net income minus dividends related to the preferred shares divided by average weighted average number of common shares outstanding. This is the key here. Weighted average number of common shares outstanding. Not the average, weighted average. Means to calculate weighted average, we're gonna see exactly calculations. So for this calculation, we're gonna use this example. We're calculating only and only weighted average number of the outstanding shares. Assume that this company has this following structure of the common shares. I'm going to copy this and I'm going to move to Excel spreadsheet so I can show you the calculation of the weighted average. Let me grab it first, copy it, and let's move to Excel spreadsheet. Do you want later this Excel spreadsheet posted for you? Okay. So this is the scenario now. There are different ways, 4 different ways to calculate the weighted average number of outstanding shares. First option is, obviously we're chasing the weighted average during the entire year, over 12 months. Option 1 is, first you're getting how much are outstanding from January to May. January to May, how many months are those? 5 months. 5. How many are outstanding? Number that will be number of the months. How many outstanding? That will be the number, correct? So what we're gonna do at the end, we're gonna get total. This one time oops, sorry. We're gonna get this 5 months here, and that will be equal to 5 times 240,000. For those 5 months, we have 1,200,000. Second, from June to August, we have how many outstanding? 200,000. And that's for 3 months, June, July, August, 3 months. So our total is 600,000. And the last piece is from this September to December, 4 months. And we have how much outstanding? 210,000. In total, we have that much. So, do you check after you do this? Do you check? Do I have 12 months here? I have 12 months. Do I have number here? I have. So, what do I have to do? Divide it. So, the weighted average common shares on this period are equal to that number divided by 12, and it's going to give you 220,000. That's the weighted average number of outstanding shares for that year. That's one way to do it. What's the other way? The other way is instead of divided at the end of by 12, you're getting that fraction right away. So I'll show you. So again, you're starting with months, number of months. Then you get the fraction. And then you're gonna get number of outstanding. And then you're gonna get the total. So the fraction is based on 12 months. I'm gonna copy this information here. And what I'm gonna do here, I'm gonna get the fraction. What will be the fraction? 5 months divided by 12. And gonna give me a number. And then I'm gonna freeze the cell. I'm gonna drag it down and gonna give me the whole fractions. What my objective is, total to be 1. If your total is not 1, that means you make a mistake. So the next thing is get the number of outstanding. And the last thing is do the calculation. This one time that one. And get all the totals. Calculate the bottom. And you're going to get the same number. Make sense? Now there's a third way to calculate it there. The third way is, again, number of months. This always starts with number of months. Why can I do this? I'm going to do it here. Number of months. We have 1, 2, 3 different calculations that we have to do. So watch this. What's happened here in reality? Initially we have 240,000 shares. Then we purchase back 40,000. We reduce the number with 40,000. And then we increase the number with 10,000. Make sense? That's what's happened in reality. First, definitely the first way is easy. But sometimes the question doesn't give you the total number. The question tells, in the beginning, there was 240,000 shares. Then in June, they purchased back 40,000. And in September, they issue another 10,000. What's the weighted average number of shares? So what you can do in this case is, you know that 240,000 are outstanding. Assume that the 240,000 are outstanding for the entire year. And then you have reduction with 40,000. And then you have issuing 10,000 from September to December. Make sense? That's what happened in reality here. Let's see what will be the final number for us here. If we get this calculation, the final number should be 210. Now, we're assuming that the first 220 are outstanding for 12 months, for the entire year. Then 40,000 are from June to the end of the year. Again, from June to the end of the year. So we have June, July, August, September, October, November, December. That's 7 months. 7 months. And the last thing is from September to December, we issue 10. That will be What will be that? That will be September, October, November, December, 4 months. Then we're gonna get the totals. Once I get the totals, I'm gonna divide it by 12 and should get the same number. Let's see if that's gonna happen. Gonna get those total. My total here will be that much divided by 12 months. My weighted average 220,000. And the last method is get the fraction of those 240, 12 divided by 4, like that amount is from January to May, then you're issuing another one, and there's so many ways to get the weighted average. Choose the one that's easy for you. You don't have to do all the ways that you calculating this. Choose the one that's easy for you. In fact, once I post this Excel spreadsheet, choose this Excel spreadsheet. Don't make a mistake, pay attention, and you're gonna get it. Make sense? So now if you have to do it, probably in the intermediate accounting, for those of you who's going to continue with accounting, in the intermediate accounting second part, you have to do it on your own. But again, choose the method which is easiest for you, go for it. So once we get that weighted average number of shares, let's go back to the slides. So again, the first way is number of the common shares, get the fraction, get the number the right way. The other way is, and the other way I already show you, there's another way. I'm gonna print you, there's one sheet with the different methods. I'm gonna print you that sheet. I cannot print it, actually. I think it's posted on Blackboard. Check that sheet. I'm gonna make sure that it's available for you. How different ways to calculate weighted average cost shares. So now we're going to the stock split. If we have a stock dividend. With the stock dividend, we're gonna do deal next time. Because at this point, getting way too much. With the stock split and the stock dividend, we're gonna deal next time. And you're gonna see how we're approaching those type of questions. And the next time we're gonna see what we're gonna do with the statement of equity and how to prepare that statement of equity. I mean, if you have questions,